But lots to take cognizance of as well when it comes to the bond yields, which ended at about 5.99% just yesterday, rising nearly 10 basis points in the last two trading sessions. We'll talk a little bit about the RBI OMOs and what the outlook is for the bond yields and the opportunities within the fixed income space. Our Sivakumar is the head fixed income at Axis Mutual Fund, who now joins in on the show. Mr. Sivakumar, good morning. Now, bond yields have corrected below that 6% level post that RBI's Operation Twist, the HTM limit relaxation as well. What is it that your outlook is on some of these measures, and when do we see the yields settling, especially when the fiscal deficit is likely to remain elevated?
Yeah, good morning. And, so it's interesting that we've had those pulls and pressures on both sides of the market. We've seen a fair amount of volatility, but eventually the 10-year G-Sec seems to be settling down around the 6% mark. What seems to be happening is, of course, over the last several months now, we've had this extraordinary spate of rate cuts and open market operations and of various kinds, which has added to liquidity, which in the ordinary course of events, we should have seen yields come down, but they have been stuck at 6%. In fact, they were at 6% 6 months ago, pre-COVID. So it does suggest that the market is more worried about, on the one side you have the rate cuts, on the other side the worries about the fiscal position is keeping the market on edge. And I think even the RBI has signaled both sides. That is to say, they've, on the one hand, when yields rose about the 620 mark, they intervened to calm them down. But at the same time, it doesn't look like they are going to push the yields lower significantly than 6%.
Okay, we have seen a number of measures that have been doled out by the Reserve Bank in addition to the recent OMO operation, about 10,000 crores of G-Secs being bought by the Reserve Bank. Do you see more such measures?
I think the RBI is in a difficult spot when it comes to open market operations because on the one hand, they do need to do OMOs to support the G-Sec markets to keep a lid on yields. On the other hand, they realize that keeping liquidity in excess for an extended period of time could in itself become inflationary over a period of time. And given that already CPI inflation is somewhat uncomfortably high, I think they're going to find it difficult to sustain doing direct open market operations. So the switch from OMOs to Operation Twist, which is relatively liquidity neutral, is, I think, a very important signal. The second signal, of course, is the fact that they seem to be intervening less in foreign exchange markets and allowing the rupee in some sense to appreciate a little. So I think these two steps in some sense have to be seen in this context of somewhat elevated inflation, but and RBI not wanting to significantly add to liquidity in the markets. So therefore, you do see RBI intervening through open market operations, more in the nature of twist, which should keep a reasonable lid on yields. But I think we should not expect the RBI to do outright open market operations unless we see a shrinking of the monetary base. I would imagine one such shrinkage of the monetary base could be the reversal of some of these LTROs. We'll have to wait and see how that pans out.
Sure. Sivakumar, what about investments in fixed income? And what opportunities do you think emerge from investment both at the longer end of the curve as well as the shorter end?
So a lot of where we see value is actually at the longer end of the curve because the shorter end of the curve has really reacted a lot to these extraordinary monetary policies. So we've seen yields across the shorter space, money market and let's say short-term bonds up to 5 years really have fallen in the last 6 months, while, like I said, the 10-year or longer actually have not reacted at all. And so there is a lot of value, I think, in the longer end of the curve as these situations normalize. So, for example, in the next couple of years, we should expect the fiscal position to improve as tax collections get better. I mean, you must remember that a large part of the expansion in the fiscal deficit this year is on account of weaker tax collections projected. And so that should change. And secondly, the RBI will start to withdraw this kind of extraordinary accommodative monetary policy in the next 2 years. So this should lead to a more normal yield curve instead of this extraordinary steep yield curve we are seeing. So actually like long bonds at this point of time, before 5 years where we see a lot of pressure in the next.
Sure. So what kind of return expectations should one have now from fixed income?
I think one of the fundamental things is the last 2 years, we've seen this huge drop in rates from, 10-year G-Secs were above 8% in 2018 and now they're around 6%. The shorter end of the curve, AAA corporate bonds 4 or 5 year have fallen from, closer to the 9 mark, in fact, 875 kind of levels to closer to 5%. So we've seen this extraordinary softening of yields in the last two or so years. And that means the returns from bonds have been fantastic. I think going forward, we're not going to see that. The rate cut story has come very close to an end. And we should expect that in the next, when you look at a little longer term, which is the next 2 or 3 years, that the RBI will indeed be on a rate hike path. That means we will now have to start building portfolios which are resilient to rate hikes, which still can hold value even if rates start to move up. So I think the returns from here on will look, more like the yields on portfolios simply because the capital gains will come closer to an end. Of course, there are no promised returns in capital markets, so therefore there's no way to know that for sure. But my expectation is that we will be looking to deliver some kind of small alpha over the yield on the portfolios through these active strategies. But the one-sided capital gain story of the last 2 years, I think, has come to an end.
Sure. What about asset allocation within fixed income as well, in terms of, which funds and also between fixed income and equities, the kind of proportion that you would recommend at this point?
So within fixed income, I think investors, I think, have become very overweight on short-term AAA corporate bonds. That's where we see a lot of flows which have come into the industry, into the mutual fund industry, and even with us at Access. But I think investors should start looking outside that. Like I said, we see a lot of value in long duration securities. We also see value in non-AAA, in credit space, where again, we've only seen outflows over the last 6 months or so. My expectation is that as the economy starts to improve, as macro conditions start to improve, this will also feed through into credits. And as long as we are really selective about what we are owning, I think that has significant value. So we should expand a basket of investments within fixed income to make sure we have a balance of assets. The only segment, like I said, which I would underweight is probably, your 3 to 5 year sovereigns and AAA, which I think are overvalued in the current environment. Other than that, I see a lot of value in fixed income. When it comes to equity versus fixed income, it's a very, very different take. I think equity markets are pricing in a very different environment from what debt markets are pricing in. Bond markets are still concerned about the state of macro. It's not that we are seeing that growth is really back in a roaring way. While in equities, it's a very different take. I think equity markets are, in some sense, reflecting the fact that it's at the end of the day, an index, the equity index is reflecting the fortunes of the top 50, 100, or maybe at max a few hundred corporates. And the consolidation of business that we have seen in the current environment, with the lockdowns affecting smaller businesses much more than larger businesses, the consolidation means that the equity indices are doing well. So we have a very interesting state of affairs. So I believe that in equities, again, it's a case of finding earnings growth. You can find earnings growth going forward. On fixed income, like I said, it's more about preserving value and trying to find a few small edges. As always, the asset allocation recommendation is very, very personal dependent. But I would say that, again, having a balance in your portfolio makes a lot of sense.
Okay. On debt outflows as well, what's the outlook? We've already seen about 15 billion so far in 2020.
I'm sorry, can you repeat that question? I didn't hear that.
Yeah, just your outlook on debt outflows. We've seen about $15 billion so far in 2020. We're also, likely to see a continued lower interest rate regime globally. What's your outlook going forward when it comes to the flows on the debt side?
Sure. So, a lot of these, the outflows are really sparked off by the initial phase of panic that we saw, let's say in March or April, when you had a significant outflows from emerging markets. That was really the pain pressure in terms of real outflows. But I think the monetary policies in the Western world, chiefly the Fed and the other central banks, pushing liquidity into the system has meant that actually flows are now beginning to recover. And my expectation is that flows actually will start to favor emerging markets again. The dollar has been in general quite weak, which again is favorable to flows to emerging markets. So my expectation is that flows will start to come back. A last point, which is very important to keep in mind, is that a lot of debt flows into EMs is led by views on currency and growth. That's to say that most of the globe views emerging markets as a kind of a risk asset. And therefore, flows into emerging markets really happen when the views on currency is positive, which is in turn linked to view on growth. So I think we need to really see people's view on this post-COVID growth getting better before we start seeing significant improvement in the flows. So while I do expect flows to return, I think we should see big flows only when we are in a genuinely post-COVID environment.
And what do you advise to investors in terms of the asset allocation between fixed income and equities?
I think it's important to have your own risk balance and therefore your own asset allocation in mind. At this point of time, I would say, do not change asset allocation just on the basis of market movements. We have seen some extraordinary volatility on both asset classes and some extraordinary policy outcomes in both asset classes. This is not the time to change your core asset allocation. So if you had a mix going into this pre-pandemic when it was 60-40, then please maintain your 60-40 or whatever asset allocation you had. I am never of the belief that that you should change your asset allocation based on market movements. The second point is that we're also not seeing extremes in valuation in certainly when it comes to fixed income, which is my forte. I think the markets are reasonably valued. So again, we're not seeing a trigger which suggests that we should be significantly overweight or underweight fixed income, which could give you the opposite view on equity. So for example, I would still suggest that there is significant value in fixed income for sure. So I would say maintain more of a balanced asset allocation.
Okay, let you go on that note. Thanks much for taking time out and giving us an insight as to what the outlook is in the fixed income markets as well as where you see bond yields headed.